Imagine a system where the rewards for hard work diminish over time, creating a race against the clock. That's Bitcoin mining. When Bitcoin launched, miners earned a hefty 50 Bitcoins for cracking cryptographic puzzles and adding blocks to the blockchain. But there was a catch. Every 210,000 blocks, about 4 years, a halving event slashes those rewards in half. Today, miners earn just 3.125 Bitcoins per block, and by 2028 this will shrink to 1.5625. Miners are the backbone of Bitcoin. They validate transactions, secure the network, and keep everything running smoothly. But without block rewards, what's their incentive to stick around? Enter transaction fees. The hope is that by the time rewards run dry, Bitcoin adoption or its price will have soared, making fees lucrative enough to keep miners in the game. But here's the twist. Fees have historically been a small slice of miners' revenue, except for rare spikes during bull markets. Even with recent developments like Bitcoin ordinals, essentially NFTs on the Bitcoin blockchain, causing fee surges, there's no guarantee this trend will hold. It's a puzzle within a puzzle. And yet, miners have a few tricks up their sleeves. Demand response programs, for instance, allow them to earn money by pausing operations to stabilize electricity grids, a strategy that's gaining traction in renewable energy hotspots like Texas. Some miners even leverage cheap or free electricity, making mining viable despite shrinking rewards. Then there's the wild card, self-interest. Imagine investment funds holding Bitcoin in their portfolios or countries adopting it as a reserve currency. These powerful players would have every reason to ensure the network's security, even setting up their own mining operations if necessary. So, will Bitcoin thrive on fees alone, or will new dynamics like ordinals or energy innovations reshape the mining landscape? One thing's certain, the journey to 21 million Bitcoins is far from over, and the stakes have never been higher.